before even going in there, because that information is going to be really important for them to figure out, okay, well, what are our real returns going to be? And is it even worth investing in this space?
Yeah, because the last thing you want to do is realize that you ended up spending money to produce something and you're not making money on it.
Yeah, exactly. And when you look at the forward curve or the cost of hedging in specific areas, specifically in South America, because their interest rates are so high, getting into South America is easy on the hedging front because you're actually getting a premium, where when you're coming back, you're getting discounted so much where, if you're looking at a three-year horizon, you could lose up to, 17, 18%, which is, guaranteed loss if you're going to hedge it right away.
Yeah. You can definitely have huge fluctuations, and now with interest rates differentiating across the globe, it's going to be crazy balancing that out. I saw yesterday someone posted in Italy, they had a business went from $100,000 electricity bill to $1 million a month electricity bill. Whoa.
Yeah, I mean that's kind of the issue with the EU, right? And the single currency side of things is that if you're not Germany or France or potentially Spain, you're kind of on the short end of the stick there.
And I guess you're burning wood to survive right now, but
yeah.
I guess looking at it from a currency exposure thing, that's taking it for that's I guess an aspect of inflation, but if someone were to have that sort of differentiation in currencies, their business would be out of business.
Exactly, and that's what we face all the time, right? So I've spent my entire career on the corporate front. I know a little bit different than the traditional Forex space where you're getting in the market, putting positions on for hope of gaining. What I'm trying to do for my clients is prevent losses, right? That way they can get back to their businesses and run them the way that they want to without having to stay awake at night thinking, God, what happens if the US dollar just crashes overnight here?
Well, the US dollar isn't going to crash. It's not as volatile as Bitcoin, but
Bitcoin. Unfortunately, I was on the wrong side of that trade.
Just keep hodling, right? I don't know.
100%.
It all goes back up. It all goes dollar cost average is what they're saying. So
yeah, exactly.
I guess speaking of the corporate space and the FX space, let's maybe dive into the differences between both of them. What does the corporate space look like? What does the FX space look like? And how are they different?
Sure. Yeah. So, I mean, like I was saying just now, the Forex space is essentially, let's analyze via technical analysis or any sort of macro analysis and figure out, okay, well, what currencies are undervalued or overvalued, and let's put positions in or buy straight up to try to make a gain. Where, while there is some aspect of that in the corporate space, it's extremely limited, because at the end of the day, what you have companies who most of the time budget for foreign exchange. So they set a rate in their budgeting process that they need to attain for the year in order to hit the profitability that they need, right? So that's essentially the benchmark. So for USD CAD, for example, I know that we're both in Canada, so it's a great example. A lot of the clients that I have who are selling USD for CAD have a 1.25 budget rate, which means that anything over and above 1.25 that they achieve for the year, that's gravy. That's great. They've gained. But anything below 1.25, now their profitability is going down, right? And we've got to always remember, especially from a foreign exchange perspective, these businesses are not in business to make FX gains, right? They might be moving to other territories to try to make FX gains just because, either the yield is a little bit higher in that currency or that currency is strengthened. But at the end of the day, they're very, very good at running their business, whatever it might be, right? Tech firm or manufacturing company, whatever it is that has that FX exposure. But when we're looking at, how can we minimize the losses? That's really what my goal is. So, I'm a licensed options trader. I trade a lot of forwards for my clients. And really all it is, my report card for my clients is, how well did we do in achieving that budgeted rate of exchange?
Well, if you love options, you probably read the Options Bible, right? So
yes.
I had Guy Cohen actually join us for an episode. So
no way. Oh, that's awesome.
Yeah, exactly. He's awesome. It's like everyone's got the options Bible, and like everybody I know who's traded options, they've all gone through the options Bible and whatnot. But when I like you said, when I think of hedging, and versus forex, just trading forex. When I'm trading forex, I'm looking to go a direction based on some news, some fundamentals, and make a gain off that. And when you're trading in the corporate space, you're trying to defend your profits. You're defending a line essentially. You're like, I see it as anything lower than 1.25, we need to make sure we're selling and capturing that, because then our bottom line gets that eats into our profits, and everything gets affected.
Yeah, exactly. The big difference here is that when we're looking at the traditional Forex market, there's not a natural covered position that you're putting on, right? You're going to cash settle it. Where in the corporate space, you're physically settling these contracts, right? In that we're looking at cash flows into the future that are 100% going to happen, or at least, at a specific percentage of, of certainty. So with that in mind, what we're doing is we're modeling and forecasting for our clients, here's what you're going to be sending out on a monthly basis. Maybe the confidence level goes down as time goes by. But what we're trying to do is we're trying to secure them rates that are going to, enhance their overall profitability, or, maintain their overall profitability over that time span. And that's really the biggest difference, is that, for me personally, I would be going long JPY right now, but I don't have a cash flow in JPY that's coming up in the next few months, where when we're talking to, I work with a mining company that sells copper to Japan. They have guaranteed cash flows in JPY that they need to hedge, right? And not necessarily hedge, but they need to actually make those payments. So with that in mind, with the ability to forecast these things, proactivity is the way to go.
I completely agree. And I guess you mentioned COVID at the beginning. Can I throw in how has COVID kind of affected the planning and the strategy for everything? Because we're hearing I've been reading the Great Narrative by our buddy Klaus, and
Nice.
We're talking about the whole thing. They say is just-in-time supply chains are being shattered and destroyed. How does if people are projecting their returns in the future, and everything's changing all at once, I feel
100%. And I mean, it really goes down to, in my opinion, interest rates. Interest rates are what going to be affected by these types of things, right? Inflation is just going through the roof right now. A lot of that has to do with the supply chain. A lot of it has to do with some other factors as well, whether it be government spending or, government spending in my eyes is a really, really big portion of that, unfortunately, even though a lot of people don't like to talk about it. But interest rates are really going to start hurting people, right? And I look at Canada as a good example, right? Canada has the second highest debt to income ratio in the world, next to Norway. We're already seeing what's happening in Norway economically, right? So the question becomes, from a currency perspective, because the narrative really is, if the Bank of Canada is going to raise at the same pace as the Federal Reserve, then USD CAD should stay in a relatively narrow band. But, now we have to think about, okay, well, who's going to blink first? It's kind of the interest rate game of chicken, where the Bank of Canada, in my eyes, if they have the regular consumer in mind, they can't afford to raise rates much more. Because while there are people that have fixed rate mortgages, there are a lot of people that don't. And, that debt to income ratio can only go up so high before it all comes crashing down, before consumer spending goes down, before retail sales shuts down, before mass defaults start to happen. And it's unfortunate, because in 2008, we just didn't see that real estate correction that the U.S. saw. And we could be, meeting our maker now.
Well, you did mention earlier what's happening in Norway. I'm curious about that. So how can we look at Norway as an indicator?
Well, I mean, just their spending is down completely, right? I mean, obviously they're taxed much more as well, which is kind of a blueprint for Canada. But from a consumer standpoint, Norway is starting to slow down completely. And when you're looking at their economy, I mean, it's just like any other economy in the world. It's very consumer driven. So, they're kind of between a rock and a hard place right now, between rising inflation and crushing debt levels on the personal side, right? So we're seeing that in Canada as well now. Quite frankly, I'm not sure where a lot of the money is coming from to buy these $1 million houses, specifically in the GTA, but it's out there.
Tell me about that, man, because I'm like, I bought a house and it's like, you can't buy anything for less than 2. And, it's like if interest rates go up to 20% like they did in the 80s, I'm walking away from that house. See you later.
And I mean, you're probably in a privileged situation in that point, in that, there are probably people out there at 8 to 10% that are going to walk away. And the question becomes, is there going to be enough international investment into Canadian real estate to make up for that? In my eyes, probably not, which is where, I think Canada is in worse shape than the United States, right? The United States has a debt to income ratio sub 100. Canada's is closer to 180.
Debt to income, okay. Ooh, so we're really high, huh?
Yeah. Yeah, we're number 2 in the world, next to Norway.
Better go ask them for some lines of credit now then, before stuff gets
100%. I've already done it. I got my home equity line. I got my regular line. They're at great rates. And it's the just in case holy shit fund.
Yeah. Note to self: go get some extra lines of credit. So yeah, and it's all gonna pop sooner or later, because it's winter's coming, and we'll go into those later.
But I know I just went off on a tangent, but back to the currency front, specifically to USD CAD. If USD CAD is moving right now, I mean, when there's no central bank action, it's moving directly with risk. But on the central bank front, which is determining more of its long-term path, is the Federal Reserve going to stop raising rates faster than the Bank of Canada, is really the question that we want to answer on currency volatility. And, since there's really, you can lean one way or the other. You can look at debt levels in Canada. You can look at government debt levels in the United States and figure, hey, maybe they'll stop first. But at the end of the day, no one has a clue. So that's where hedging comes into play for corporates, right? Because, I was actually just running an analysis for a client of mine on a 3-year average basis. So the realized volatility on a 3-year basis is 23%, which means that every 3 years, so we took, over the last 10 years, we took 2002 to 2004, 2003 to 2005, so on and so forth. The average 3-year high to low differential is 23%. In USD CAD. So between the high and the low.
The rates. Okay.
Yeah. So 23%. So I don't know a lot of businesses that have profit margins of 23%, let alone the ability to swallow a 23% move against them. So that's where the importance of FX risk management comes into play. And risk management can be a number of different things. That doesn't have to be hedging, right? It could be a number of things where it's monitoring the market until it gets to a point where you have to hedge. But at the end of the day, it's just ensuring that what you're doing and you understand what risk you're putting forth, by interacting in these different currencies.
Lots of times businesses, like a growing business, they just don't even know what's happening to them because they're just growing so fast, and it's hard to really figure it out until they get their check back, and they're like, wait, we didn't make enough money on this, and then they realize, oh yeah, we gotta call up Steve and figure this thing out and get our stuff in order.
Yeah, and so I work with a lot of startups, right? So just going back to Deaglo, Deaglo works specifically in investments. So we work with investing firms as well as their portfolio companies, or even companies that have recently received investment and need to figure out, okay, well, I received US dollars, but I'm a GBP, or I'm a UK-based firm whose operations are in GBP. It's debt financing, so we've got to pay the loan back in USD. What happens over that 3-year intermediary term if we see, GBP USD go one or the other by 10%? So, that's where we come into play here. And because, it's been very, very flat over the last 10 years relative to the 20 years before that, right? I think that I'm probably too young to have experienced crazy volatility, at least in my career. But when you look at a chart, you think, wow, like it's pretty flat right now relative to 20 years ago. So if we go back to those times, any company that doesn't have a firm FX risk management policy is putting themselves in complete unnecessary risk.
Yeah, well, everything you're talking about, it also sounds relevant to the crypto industry, because everyone's trading in crypto and making money in crypto, but then when you got to convert back to trading your Bitcoins or your Ethereums back to dollars and you realize you're at a loss, could definitely use some help hedging that stuff out. I know Celsius could have used some help hedging that stuff out, maybe.
Yeah, absolutely. Yeah, it's unfortunate what's happening in the crypto space right now, right? I mean, I'm certainly not as well versed in crypto as I am in foreign exchange, but I certainly dabble. But yeah, I think that we're at a point now where I think there's over 10,000 coins or something like that, or 10,000 tokens.
Yeah.
And I think a lot of them are going to get weeded out, right? I think the space is going to be utility based. If it doesn't have utility, then it might not survive.
Yeah, all these projects are running out of money slowly but surely, right? They all have a burn. They all raised money in coins, and now their coins are slowly burning off into oblivion. So,
and the common theme that you're seeing is, we're not going to spend that money, that marketing money, during a bear market, but if the bear market lasts as long as the last one did, the coin might not be in existence, and by the time it's time to spend that marketing money.
Yeah, I have a feeling this one's going to last a little while.
I think so. Yeah, it's. I mean, don't get me wrong. It'd be nice to see my Bitcoin holdings back at 40,000 a coin.
Oh, you're dreaming for 40. We want 60.
Oh no, I'd love to see 40 first, though, right? At least I'm going to gain at that point. But yeah, I think we have a greater chance of seeing 11,000 before we see 40 again, unfortunately.
Yeah. 10 to 11 is where it's got to go. Just from the original, just from a support resistance level, yeah. It's got to come back and touch the chart somewhere around there before it can go back. But it coming back to 3,000, it had to come back to 3,000 because it shot up from 3,000 and went directly to 5, 7, 8 and never came back down.
Yeah.
So it had to come back to that area, test it, make that level, and now it could rise up, which is nice to see because it is acting as an asset class should act in building up its support and resistance like that. So yeah. It is maintaining the law of how it's working like that. It's pretty interesting.
Yeah, and then we're seeing ETH as well, right? ETH is starting to get a little pump right now. There's some great news on the horizon, but it could just be one of those, buy the news, sell the event type of scenarios, which I know a lot of economists are calling for.
Yeah, well, it's gonna have to save a lot of problems, and everyone's trying to solve the same problem, and it's starting to get old because they don't have the authority to solve the problem. They don't have the authority to do payments internationally or whatnot. So you can't solve that problem until you get the proper authorities to do it.
Mm-hmm.
So, but I think I saw Vitalik saying that they want to move into payments. That this upgrade is going to help them with focus on payments, but.
It could. I mean, probably not on the Ethereum network, but or it could be on the Ethereum network, but it might not be ETH based, right? I have a feeling that it's going to have to be some sort of smart contract in an altcoin or something like that.
Yeah, but forget cryptos. Let's go back to FX, and I guess going back to the corporates and do you think FX firms take advantage of the lack of client knowledge?
Oh, absolutely. Yeah, I mean, I saw it firsthand. From a spread perspective, I mean, that's really it, right? The fundamental conflict of interest that you see in the FX corporate space is that, you've got these firms that claim to be, for the client. Let's make sure that we're your outsourced treasury team, but they make commissions off of that. Trader makes commissions off of every single trade that you book. So one thing that came to Canada quite a while ago, in the United States, it's becoming more prevalent is FX options. Now, FX options, at face value are a really, really great way to hedge, specifically structured options where, instead of outright buying an option or selling an option, you're putting, a bought option and a sold option together, and it's a zero cost for the client. And instead of one specific scenario like you would have in a forward where it's, locked, you can create a range of trading. And it's really, really good. It's worked out for a lot of corporates, and a lot of corporates use it. The problem with FX options is that without regulation, you could charge whatever you want for them. So, if you're charging 20 basis points for a forward, your client knows you're charging 20 basis points, and it takes a Google search to look it up. But you can charge, 1 to 2% for an option. They have no idea. Now, everything's fair in that perspective, because if the client is happy with the product, that's great. The problem now is that there are super, super aggressive structures out there that are being sold aggressively, where the client is taking so much risk without actually understanding it. And firms are making 1 to 2% on these things on massive volumes. Like I would guarantee you that the average FX firm probably has between 25 and 50% of their overall revenue in these types of products. And the thing about it is if you're getting commission for booking these trades, you're obviously incentivized to go to your client and try to sell it to them. So it's an inherent conflict of interest, and it's running rampant in the industry right now. So, one thing that I wanted to do is I actually started between my last role in a brokerage in Deaglo. I started a consulting firm, but unfortunately, people don't want to hear it, right? They think, hey, on this product, I'm getting 3 cents better than the current spot. I'm cool with that. But the thing about it is that in a big market move, it will always come back to bite you.
Have you seen situations like this, and how bad have they looked? For
sure. Yeah, I mean, the brokers that I was working with that I was telling you went under for COVID, was a direct result of these products. So
they couldn't too much trading.
It didn't just take out the company that was booking them; it took out the brokerage itself.
Oh wow. Ooh. Yeah, that's scary.
So they perform really well in an environment where you're seeing very little volatility, because what happens is that the function of these products is that you have a specific amount that you can gain on it, and it's on a monthly basis. So usually what people are doing is they're booking a 12-month strip. Every month you gain X amount, and once you gain Y amount, it's completely knocked out. You can book a new one. So as long as the spot doesn't move too much, you're generally being knocked out within 2 months. But if it moves a lot, you're either knocked out right away, which is fine. That's not a big deal. Or you're leveraged like crazy, and you're now on the hook for 12 months worth of 2 times the amount that you originally were trying to protect. So the mark-to-market perspective, you're getting margin called right away. You're also booking at a way worse rate than what the market would be at. And if you don't have the funds for that margin call, that's going to create a chain reaction, which is exactly what happened during COVID with a lot of these brokers, that clients weren't able to pay margin. And I don't blame them.
Yeah. So, wow, because at that point, they're like, just abandon the strategy.
Yeah. Yeah, exactly.
We'll just write off this loss and abandon the strategy.
Yeah, I mean, that's the hope. The hope is that they can eat it and write it off, but some of these companies couldn't.
Yeah. Yeah, especially when your sales are going down, everything's going down. Yeah, it was probably a crashing environment. Like.
Oh yeah, I mean, it was the perfect storm, right? And no one saw it coming, but just from a risk perspective, hopefully a lot of companies on the FX front and businesses learned from that.
Yeah. And in terms of what are some of the hardest currencies to hedge for when you're out there for some companies?
BRL. It's actually, so the Brazilian real, it is extremely hard. I mean, number one, it's the most volatile currency pair in the world, or at least one of them. when you're looking at the day over day or even week over week movements, it's absolutely insane. Like I had a client of mine that they needed to sell 10 million USD into BRL. There was a rate of 5.5. They saw a 2-day lag time on the amount of time that, or sorry, 2-day lag time on getting the US funds to their broker. All of a sudden it was sitting at 5.19. So they lost essentially zero point 0.2 or 0.3 on $10 million. So that alone on the BRL front is tough, but on the other front, so we do round trip hedging is what we call it. So I alluded to this a little bit at the beginning of the podcast, but let's say there's a US investor that wants to invest into distressed assets in Brazil. So, buildings, real estate, land, they're going to be sending BRL to Brazil, holding those assets, and then over a 3 to 6 year horizon, they're going to be bringing it back once it's all harvested. The 3 to 6 year cost of hedging in BRL is absolutely insane. So to even quantify whether it's worth doing, you quantify the cost of hedging. You've got to figure out what your perceived return is going to be before the hedging cost, take away the hedging cost and say, is this even worth it? So there are a lot of firms that say, yes, it's worth it. And they're the ones that work with us because we're able to manage their risk effectively. But leaving it open to FX fluctuations, the value at risk over a 3-year period is close to 50%, which is absolutely insane. Yeah, and looking back at BRL, right? Who would have known that we would have been in the fives right now 3-4 years ago? So I remember
you're about like 15 to almost 20, right?
No. So we're at the highest range that we've ever been at right now.
Okay.
But back in early 2020, when we were in the low to mid fours, that was the highest rate we've ever seen. So a lot of clients were hedging, and they were saying, yeah, it's not going anywhere. But the clients that did hedge with us on the investment front, had they not hedged, they would have seen a 20% difference in the FX rate, guaranteed, which is, it wipes out profitability.
Yep. Oh yeah. It does. But there's so much trade with Brazil. They're one of the biggest producers. They produce so much raw goods, materials everywhere.
And it's increasing too.
Yeah. They're fastest growing, especially whatever happens with China, like Mexico, Brazil, Colombia. They're going to be picking up the slack.
Absolutely. Yeah.
Well, speaking of world politics, we had a question from Lockster, and is, what are your thoughts on SEK, Swedish krona, if Sweden joins NATO? I was like, I haven't thought about that one.
I haven't thought about it either. I think it would all come down to the risk side of things, right? I mean, if we start to see Russia, strutting around saying, hey, bad idea, kind of like they've done in the past before they signed it, we could see a bit of a weakening in SEK. Actually, it would be very likely if Russia were to respond or at least make threats. But to see a long-term weakening in the SEK, we would need to see something really materialize on that front.
Yeah, well, there'd have to be some. I think it's more posturing what's going on right there, like political posturing rather than something that's going to really affect the currency.
Yeah, and the question becomes at that point, has Russia postured or over postured, if you will, because they've been doing a lot of posturing and no one's been calling their bluff, but they haven't been acting on it. Thank God. But, is posturing going to do anything? On the other hand, we can look at Sweden joining NATO as something that might get rid of risk in that environment, right? Does Russia really want to go to war with a NATO country, knowing full well what the repercussions might be? So the market might actually see that as bullish for SEK.
Yeah, I agree because it only strengthens their position. And my thought is, okay, if joining NATO, does that bring them one step closer to getting rid of their, shared their unique currency and becoming a shared currency? That would be my thought, but I don't know, interesting.
And at that point, the question really becomes: is that already priced in? Right? If the market fully believes that Finland and Sweden are joining NATO, it might already be priced in. So it could be a non-event as well.
Yeah. And I guess, how would you describe the current market environment? Like, that's a very broad question. It's like asking, like,
the current market environment in my eyes is whole, close your eyes and hang on, quite frankly. I mean, from a currency perspective, it's really easy to see the US dollar start to take off here, especially as time goes by and it looks more and more likely that there is going to be a global crisis. Inflation is rampant. The one thing that is really kind of holding the declaration of a recession back is employment. But, we're already seeing these big firms. Google's already said there's going to be blood on the streets if their Q3 results come in worse than expected. So I think that Q3 is going to be really, really important to figure out whether or not a true recession is coming. That's really what I see, is that the only reason why we haven't seen a recession cleared is employment. And once that starts to go, if it starts to go, we'll be in a full-on recession. And it could be a really, really bad one.
So I feel like the employment thing is really hard, because you're seeing so many people having all these part-time jobs and gigs, and they're not included as part of the employment industry anymore. And so many jobs have gone away due to digitization and AI. I think that's what
the participation rate is so low too, right? In Canada, it's in the 60s. So, it begs the question of, are there people out there that are just okay not working? I mean, you can see that there's going to be a percentage that are fine not working, obviously seniors and, people on maternity leave, but 60-something% in participation rate is very, very low. So in my eyes, I don't see employment keeping up. I mean, we already saw it in Canada. Canada lost, or Canada's not doing great on the job front. The US is doing really well on the job front, but participation is not great as well, right? I mean, in Canada, we lost jobs, but unemployment went down.
But that's my thing. But you can say employment is great, but when you only have 50-60% participation, that means there's going to be a pull on the system somewhere down the line, or a drag.
Yeah, but those are the benchmarks that they use, right? And that's really the thing. Until a recession is declared, which is it's so arbitrary.
Let's redefine, make a new definition for a recession. But yeah.
Yeah. It really comes down to what is it called? The NERB, or National Economic Board. It's essentially 8 economists in the United States, and it's their job to declare recessions. They were the ones that have declared recessions since the 1970s and the ends. So
leave it to Krugman, I guess, right?
I guess so. Yeah. I mean, it probably wouldn't be a good job to have from a pressure perspective, because they all, they're all named. But yeah, I don't see any scenario where we don't go into a global recession. Governments are spending way too much money right now. It looks like the United States is just looking for excuses to send billions of dollars outside of the United States. Inflation's not going anywhere if that continues.
Yeah. Well, I'll be going to Mexico soon. I'll let you know what things are like over there. But yeah, like, I'm still seeing planes fly over my house every single day nonstop.
Yeah.
You're wondering who's flying still, but no, I feel it. Like, I'd consume less. I'm like, I don't want to spend $200 to fill up a tank of gas. I'll walk to the quarter market and get my groceries. So. Yeah,
and I mean, it's really the cost of living that's gone up, right? I mean, you look at overall inflation, it doesn't look too bad, but I'll tell you right now, going to the grocery store, and I live in Alberta, I used to be able to buy a steak for $10.
Damn.
It's close to $30 now, right? And that's over a year span. I've only lived here.
Man. Damn. Yeah, it's $38 for a piece of steak over here. Well, it's the filet mignon, but yeah, damn.
Yeah, it's crazy, right? And that's unfortunately the world that we live in right now, is that we're seeing the cost of living go up, but wages are not increasing with it, or at least to the same extent.
Correct.
And that's been the truth for a really, really long time. And that's how we create massive wage gaps between the 1% and the rest of the world. And that's how the middle class becomes the lower class.
Well, there is no more middle class pretty soon. So yeah. Oh, man, well, don't get me. All right, let's switch. Going down that rabbit hole. All right, what can help corporate investors select the right and reliable investment options? What?
Honestly, understanding what's out there from a strategy perspective and pinning them against each other and figuring out, what is your worst case loss and what is your worst or best case gain. So, I mean, FX or at least FX hedging is a risk reward game, right? How much are you willing to risk in order to reward? Now, there's going to be a worst case risk, and that's going to be the same with every corporate. What is going to be my worst case risk? Where there are going to be people out there that are investing in the Forex market that are saying, hey, let me just sell this call. I'll take the upfront premium, and I'm cool taking unlimited risk because I think that asset is going to fall, right? But in the corporate space, that doesn't happen. So a lot of corporate investors are really just looking for, number one is certainty. That's the biggest thing, is certainty and cash flows. They don't want to spend time awake thinking, God, should I check my phone right now? Let's see what's going on with the currency, especially if it gets close to that rate where they're not profitable anymore. That's when they start to really panic. So, what we've done at Deaglo is we've taken a lot of technology. So Paul Stafford, who's our chief technology officer, NASA scientist, he worked for NASA in the engineering department for years, but he's using Monte Carlo simulations to pin different strategies against one another. And essentially it's 10,000 different simulations that he's using. Then he's coming up with plots to show different distributions on how they might perform. And the benchmark is not profitability. The benchmark is the rate that you decide is that death rate, or that rate where you're not profitable anymore. So, being able to quantify, number one, what is out there, and number two, how do they compare against each other in any different market? Those are the tools that you really want to take into consideration when you're making an investment on the corporate front, at least from an FX perspective.
Interesting. Well, talking about FX perspective, but one of the first things that got me interested in FX was when I was back in university studying different balance sheets, and then you look at the balance sheets and you see a little, we made an extra 27 million because we were successful in our hedging strategies. I was like, interesting. They made money on top of hedging for their business because they're successful in hedging. I'm like, that's another way to add money. I was like, but there's also the risk to it. And sometimes I saw companies that lost money, and I was like, this sucks. But then I was like, but they protected their profits. So.
Exactly. And that's the thing, right? And whenever I'm talking to my clients, I might take a different approach than most, but once we put a hedge in, because we're not hedging 100% of it, the first thing I say to them is, I hope this hedge loses. And the reason quite frankly, the reason why is that what you want is not for the hedge to win, because if the hedge wins and it's in the money, then what you're going to have to be doing on spot is at a worse rate for you. So if you're making the conscious effort to hedge, you have to put that hedge aside and understand that if the rate moves up, meaning the hedge loses, your overall profitability is actually going to be higher.
Well, if the hedge loses, because you've only done a small portion, so you're still
exactly. So let's say, for instance, it's a US dollar seller in Canadian dollars. If you hedge right now at 129 for 50% of your exposure, leaving 50% of it exposed to the market, and we end up at 127, your average rate is 128. But if you hedge at 129, we end up at 131, and you do your spot at 131, your average rate is now 130. So that's what I mean. There are a lot of people that like to look at hedges within a vacuum and say, I hope this performs well. Where on the corporate space, and this is another key differentiator, it's not about one specific trade. It's about your entire year and how you do relative to the budget that you've set for that year. or any sort of period, right? There are companies that budget quarterly. There are companies that budget based on a specific trade or a specific deal that they do. But when we're looking at the cumulative portfolio, that's what we want to analyze, not, did this hedge work? Did this hedge work? Or did this hedge win? Because at the end of the day, if all of your hedges lose and you're not hedging 100%, you're actually coming out better than you would have if all of your hedges won. So that's the key difference, right? Is
because if you're only doing like 50%, because if you're only covering like 30 or 70%, then that leaves the other 70% to go up and whatnot. And the reason why you're doing that is probably because you want to protect your profits to stay within a range, and that's your goal, is to keep there in the range and not try and make money off it, to keep them within a band.
Exactly. So some of the stats that I look at with my clients are, once they have hedges in place, what is the spot rate we need for the rest of the year in order to achieve your budget? So let's say, for instance, we're coming up on the end of the year here. So a lot of the corporates that I'm dealing with, the rate that they need for the rest of the year, specifically the ones selling USD into CAD, is significantly lower than current spot. Because we've hedged, we've put on layers of hedges, we've done a lot of spot as well, all above their budget. So, for a US dollar seller that needs a 122 for the rest of the year in order to hit their budget, we're at 129 right now. So they can either let it ride because we've got a huge buffer between current spot and what they need for the rest of the year, or they can hedge it all and take that profit of 7 cents for the rest of the year. But it's those kind of things that really differentiate the corporate space from the investment space, right? It would be nice if you're hedging 100% for all of your hedges to win. Reality of the situation is that there are way too many variables when you're thinking about hedging for a business to keep in mind to be 100% right all of the time. So when you're looking at the Forex investment space, your goal is to win. Right? Your goal is to analyze and say, hey, I think that this is going down. Let's throw on a short, take profit. On the corporate space, hey, we're higher than our budget, throw on a position, because all we're going to do now is we're going to increase that buffer between current spot and the rate that you need for the rest of the year.
I like that. Buffer it up.
Exactly.
I like it. And let's talk a little bit about Deaglo. What do you think the reasons for Deaglo's success in facilitating corporate investments are? Or where?
We hit a niche that a lot of people don't. I mean, the Monte Carlo simulation models that we use, Monte Carlo simulation is available to anyone, but the way that we utilize it within our platform is very unique to the space. That's number one. Number two, quite frankly, there are not a lot of players out there that are going after investment funds and helping them manage their risk. It's a very different story to tell than corporate risk management. What we have to do is we have to look at not only the funds in, but we have to look at the funds out. So we look at it as a complete package, and we talk to them about, the stuff that a lot of people will never talk about in the corporate space, which is, IRR, Sharpe ratio, all this stuff that only these investment funds will be familiar with. I wasn't even familiar with those terms before I came to Deaglo, and I've been in the corporate space for almost 10 years. So there are a lot of different variables that you have to look at on the fund space. And, the team that we have here, our CEO is just an absolute rock star. His name's Ashley Groves. I've never seen anyone with the type of energy that he has. So he was
great. When we had that call, he was great.
He's awesome. But he is able to garner these relationships. From a sales perspective, he's a superstar. But on top of that, the way that he carries this company and the people that he's brought on board to fill specific roles, he always says he's not going to add anyone to the team that is not better than him at the role that they're made to do. And so, he's humble in that regard, in that he's going to add the people that are going to complement his skill set. And it's a tight-knit team right now. We've got some very, very aggressive growth plans in the future. But right now we're focusing on the present, making sure that we're hitting all of our benchmarks that we're looking for now.
Awesome. And so if you find people that might not be suited for Forex investment, what do you tell them?
We're upfront with them, right? I mean, that's the thing. So, I mean, a lot of the people that or the funds that are coming from to us, we're charging them a project fee, right? Because there's a lot of work in the initial analysis. Now, don't get me wrong, we'd love to charge them a retainer for their ongoing business, but if it doesn't make sense, it's not in our best interest to make it make sense. You know what I mean? We're not gonna, we're not gonna just throw out bullshit to try to get clients on board, because that's not how we develop a good name for ourselves. So every client that we have, or at least almost every one of them, is willing to give a referral to any prospect that we have. And when you look at the names that we have, it's incredible that they're willing to do that. Like, some of these firms are dealing with billions of dollars in assets. So in order to keep that good name in Deaglo, we can't go to a potential client and say, hey, yes, it makes sense for you to make this investment, when we know deep down that it makes absolutely no sense. Now, we haven't come across that type of scenario yet where it just doesn't make sense from a cost perspective, but I'm not saying it's impossible.
That's where integrity comes into play.
Yeah, and that's something where I mean, integrity is something that is very important throughout the entire financial industry.
Yeah,
and it's a rare thing, and yeah, I'm happy Deaglo has that.
Yeah. Well, the way you speak, you represent them well. So.
Hey, thanks. I appreciate it.
I guess we're coming up to the 1 hour mark. How can people learn to connect with you, find out more about Deaglo?
Yeah, so www.deaglo.com is our website. You could also find me on LinkedIn, Steve Kulchyk. And yeah, I mean, we're working specifically with the corporate space, with investment funds, and really anyone who has any sort of FX exposure that they're looking for assistance on. I mean, I'm not too picky when it comes to my client base, but always happy to field a call, even if it doesn't turn into business.
We might have to have a chat sometime soon, Steve. Got some questions for you.
Sounds good.
So thank you for your time today, Steve. I'll definitely be in touch. Got some questions for you offline, and I hope everybody was able to learn something. We'll see you soon. Thanks, everyone.
Thanks, everyone.